Hello and welcome back to our course on financial modeling and analysis. If you had noticed in the three-statement financial model, we just assumed that the company will not make any more loan repayment. This is almost not realistic in the real-world scenarios because in the corporate world, companies will normally get into loan agreement, and within this loan agreement, the company will be obliged to pay monthly or quarterly interest rates and part of the loan principal. In this section of the course, we are going to see a standard corporate loan agreement, how it is calculated, how the model is built, and how to link this with a three-statement financial model. Let us assume that our company in this case has decided to take a loan of $75 million to finance part of our capital investment in the long run. This loan has been divided into two tranches. The tranche A loan amount will be $50 million to be repaid quarterly for 8 years with an interest rate of 6%, while the tranche B has a loan amount of $25 million, and the company will have to repay the loan within 32 quarterly periods, that is 8 years in total. But within the first 5 periods, the company will be expected to pay just the interest on capital. Then from the 6th period, the company will begin paying the interest and part of the principal. Let us begin by modeling out tranche A of this loan agreement. We are told that the company gets a $50 million loan to be paid every quarter for the next 8 years. This means the loan will be repaid for 32 periods, given that there are 32 quarters in 8 years. So let us calculate the total payment the company will be making every quarter. First, we calculate the quarterly interest rate, which is going to be equal to annual interest rate divided by 4. So we have a quarterly interest rate of 0.015. Now let us calculate the payment the company is supposed to be making quarterly, which is equal to payment. The first variable is going to be our interest rate, which is 0.015, comma, the number of period, which is 32 period, comma, then the present value is the loan amount we are receiving today, which is equal to $50 million. Then our future value is going to be 0, meaning that by the 32nd period, we must have repaid all the $50 million owed. This means that our company is supposed to make quarterly payments of $1,978,855. Now that we know the quarterly payment to be made by our company, we can now determine which part of the quarterly payment will form interest payments and which part will form the principal. So this loan is supposed to be repaid within 32 periods. That is 0, 1, 2, right up to the 32nd period. So at period 0, which is today, our opening balance, which is the total amount of loan we received from tranche A, is $50,000. Opening balance equal $50,000. And our closing balance is going to be the same, $50,000. Now, from the first quarter, we are still going to have an opening balance of $50,000. In this first quarter, we have to start paying our interest on the loan, which is equal to quarterly interest rate. You fix that with F4 multiplied by $50,000. So we now know the interest we are going to pay in the first quarter. Remember that we also know how much we are supposed to make as total payment for this quarter. The total payment is equal to payment from our calculation. We just negate that value so that we can have a positive value in our amortization table. Since we know the total amount we are paying every quarter, and we just calculated the interest rate to be paid this first period, this means we can easily know the amount to pay for our principal by subtracting the quarterly interest rate from the payment, which is payment minus interest rate. Note that the interest rate you pay is the benefit the lender gets as you use his or her money. This interest does not affect the lender's total sum you borrowed. So to get the closing balance you're owing the lender, this will be equal to opening balance minus principal. So the logical flow continues. The opening balance of what you owe this new period will be the ending balance of what you closed with the last period, which is equal to $48,771,145. The company is going to make the same payment for all 32 periods. So we just fix that and we pull right up to the 32 period. So we can do the same for the interest rate. We just pinch and pull that right up to the 32 period. To get the principal, as we said earlier, is basically equal to payments minus interest rate. We are going to maintain that same formula, so we just pinch and pull that right up to the 32 period. To get our closing balance is equal to opening balance minus principal payment. We just pull and take that through right up to the 32 period. And we do the same for the opening balance. We just pinch and pull that right up to the 32 period. Excellent. We realize that right up to the 32 period, we are going to have a closing balance of 0, which means this company is expected by the 32 period to have liquidated all the loan she is owing. In our next session, we are going to model out the tranche B loan. Hello and welcome to tranche B of our loan agreement. The tranche B loan is totaled at $25 million with an annual interest rate of 8%. However, it should be noted that from the 1st to the 5th quarter of this loan, the company will be required to pay just the interest. Then from the 6th quarter right up to the 32nd quarter, the company will be required to pay interest as well as principal of the loan. To get things started, let us calculate the payment to be made. We start by determining the quarterly interest rate, which is equal to 8% divided by 4. And it gives us 0.02. Now, we need to know how many periods we are going to be paying interest as well as principal, which is going to be equal to the 32 period minus the 5 period we are just going to be paying interest rates. So we have 27 periods that we are going to be paying interest rates as well as principal. Now, we can calculate the payment to be made for 27 periods, which is equal to payment. The rate we are talking about here is 0.02, the number of period is going to be 27 periods or 27 quarters, the present value is going to be $25 million, and the future value, that is, after the 27 period, we are supposed to have a future value of 0, meaning at this time, the company is expected to have liquidated the total loan of $25 million. We close bracket. So this tells us that we are supposed to make 27 quarterly payments of $1,207,327. Now that we have our payment calculated, let us develop our amortization table. We are supposed to develop an amortization table for 32 periods. 0, 1, 2, 3. We just pull that down right up to the 32nd period. Remember that from the 1st right up to the 5th period, we are told that the company is going to make just interest payments. So this is equal to 1st period. It's going to be the loan amount of $25 million. Let's fix that, please. And then we just pull that right up to the 5th quarter. Then the same is going to apply for our closing balance. Our closing balance is basically going to be equal to our opening balance. We just pull that right up to the 5th period. So we are told that from the 1st right up to the 5th period, we are going to be paying just interest expenses. to determine the interest we're going to be paying, this is equal to the quarterly interest rate, we fix that, multiplied by the opening balance in the first period. We just drag that through. So we realize that from the first right to the fifth quarter, we are going to be making quarterly payments of $500,000. Then from the sixth period, we are told that we are required to pay interest as well as principal. In the sixth year, our opening balance is going to be equal to the closing balance of the fifth year. The total payment we are supposed to be making in the sixth year is going to include our interest rate as well as our principal. So let's extrapolate our payments to be made in the sixth year, which is equal to, we move to the calculation of our payment and we negate that value because we want to have a positive value. And our interest rate is going to remain the same. That is, quarterly interest rate, we fix that multiplied by the opening balance. And we have $500,000. The principal payment is going to be equal to payments minus the interest expenses. Our closing balance in the sixth year is going to be equal to the opening balance minus the principal. So we have a closing balance of $24,292,673. We are going to carry out the same logic in the seventh quarter. In the seventh quarter, our opening balance is going to be equal to the closing balance of the sixth quarter. To get the interest rate, we are just going to apply the same formula, which is equal to quarterly interest rate. We fix that because we are going to copy paste formula through, multiplied by the opening balance. So the payment is actually going to be the same. So we fix that and we just pinch and pull that right up onto the 32nd quarter. To get the principal is basically equal to payments minus interest rate. And our closing balance is equal to opening balance minus principal. Our opening balance for the 8th quarter is going to be equal to the closing balance of the 7th quarter. We just hold and drag. Then we do the same for interest expenses. We just pinch and drag right up to the 32nd quarter. Then the same should apply for the principal. We just pinch and pull that right up to the 32nd quarter. And to finalize these, we're just going to pinch and drag the closing balance right up to the 32nd quarter. Excellent. So it tells us that in the 8th year, finishing our 32nd quarter, we are supposed to be liquidating these $25 million loan. Now, let us make a summary of tranche A loan as well as tranche B loan, summarizing the interest expense as well as principal payment of each and every one of these loans.
At this point in time, I guess that's because you're interested in becoming a financial modeler, a finance or business analyst, or probably you're already in the finance field and would love to take your career to the next level. We want to invite you to check out the other free parts of our courses provided in the links below. And if you're ready to become a world class in the finance and business world, we cordially invite you to take advantage of our discounts. By using the coupon codes below, you have complete access to our courses on financial modeling, where you learn how to build financial models from scratch. Then you'll also have access to our capital budgeting course, where you learn how to value the different types of capital budgeting projects or investment projects. In the same course, you also learn how to build a capital investment model from scratch. Still in the links below, you have access to our weighted average cost of capital course, as well as our Excel crash course for finance and business analysts. Thanks very much, and don't forget to hit the like button.
Hello and welcome back. Here we're going to do a summary of tranche A and B loans payment. This lower part of our summary is going to show how tranche A and tranche B of interest rate and principal is going to appear in our income statement and balance sheet. So the total interest rate for the first period is going to be equal to the interest rate of tranche A plus the interest rate of tranche B. We just pull that through. Same is going to be for the principal payment. This is going to be equal to principal payment of tranche A plus principal payment of tranche B. We just pull that through. Now let us determine the interest expenses that will be made in tranche A during the first year. This is going to be equal to the sum of interest expenses for the first year. We close our bracket. The second year interest expense is going to be the same, the sum of interest expenses for tranche A. The same will apply for the third year. Total of interest expenses for the fourth year. Close bracket. Total of interest expenses for the fifth year. Close the bracket. Total of interest expenses for the sixth year. Close the bracket. Total of interest expenses for the seventh year. Close bracket. Total of interest expenses for the eighth year. Close bracket. Next is the principal payment of tranche A, which is equal to total of principal payment for the first year, total of principal payment for the second year, total of principal payment for the third year, total of principal payment for the fourth year, close the bracket, total of principal payment for the fifth year, total of principal payment for the sixth year, total of principal payment for the seventh year, now let us do the same for tranche B loan. The first year interest expense is going to be equal to the sum of the first 4 quarterly interest expenses. Close the bracket. So the same is applied in tranche B as was applied in tranche A. So now we have a summary of our interest rate expenses and principal payment that we're going to be making from the first year right up to the 8th year, resulting from our tranche A and tranche B loans. In the next session, we are going to show you how to fit this in a 3-statement financial model, and we're also going to check the flexibility of our 3-statement financial model.